Good afternoon, everyone. Welcome. I am Zach Frank from the Earmark team, and thank you for coming to today's webinar, ERC Essentials for CFOs and Controllers. We will begin shortly. I just want to give some people some time to get situated. If you want to get the Earmark app, the QR code is on the screen. Please just scan that. And as a reminder, you can earn CPE or CE for this webinar by using the Earmark app. But unlike traditional webinars, Earmark's Webinars Plus does not use polling questions during the presentation. Once the CPE course is available in the Earmark app, we will notify you via email. At that time, you can open the app, take a short quiz, and earn your CPE certificate for this webinar. You can download the app, again, by using this QR code, or by searching for Earmark in either the Apple App Store or the Google Play Store. You can also get it by visiting earmarkcpe.com/download. All right. I want to introduce everyone to Catherine. Catherine will be hosting this webinar today. Catherine, if you don't mind coming on, there you go. And without further ado, it looks like most guests have arrived. I don't want to keep people holding up. So I want to welcome Catherine, and you could take over and get this webinar started. Thanks, Catherine.
All right, let's go. Thanks everybody for joining. This is going to be an action-packed hour. Hopefully I don't end up going too long over time, but this presentation is the Employee Retention Credit Essentials for CFOs and Controllers. I'm Catherine Tyndall and I'm a CPA. So my course objective for us today is this is really aimed for non-tax professionals, but I know a lot of tax professionals will be chiming in here. I'm going to try to keep this at the level where anybody that's a CFO or a controller or internal accounting function will be able to understand enough about what's going on, that they can determine basic credit eligibility. And my real goal is protecting your organizations from erroneous claims and just knowing when this program is going to be appropriate. So my course objectives, I'm really focused on you being able to find and having red flags go off at the right times. You don't have to master all the details of something. Really, I just want to make sure that the red flags go off at the right times for you. And so this is going to be very action oriented, and really at the level of what I think, if you're assessing this for an organization, what are the things that you really need to focus on? Mixed in with this, I know some people are going to be listening in and not being able to see the presentation at the same time, but you'll be able to get access to these slides, through the whatever channel that you're accessing this from. But there's also a lot of guidance and additional reference slides that I'm not going to talk through, but that are present for you as guidance if you have more niche issues as we go through. So a little bit of my background. Like I said, my name is Catherine Tyndall. I'm a principal at Dominion Enterprise Services. We've had over 10,000 people attend our continuing education presentations for this topic. I've been on CPA Academy with Intuit and now Earmark. We're a licensed CPA firm, and we have a specialty in corporate income tax planning and niche tax issues like the ERC. My whole professional background is in corporate and personal income taxation. So this has been a fun program, seeing how it interacts with just normal tax issues. So just a quick housekeeping item here. So for anybody who's on the live stream, if you have any questions that you'd like to submit, it's something that when I get to the end of the presentation, we'll review the questions, and I can respond to them. Or, a lot of the times I might want to give you an actual citation or something like that so I can respond later. But please do submit it. And then just as a general caveat, this is an educational platform, so no specific tax advice is going to be given for a taxpayer situation outside of a formal engagement. That's something that we do. And you can get in touch with us if you need a formal engagement. So my main points for today, we're going to talk about the basics of the ERC program. I'm going to assume you have no knowledge of this, even though you've probably been spammed with tons of advertising. We're going to spend a lot of time talking about eligibility for organizations under the revenue and non-revenue provisions of the program. The eligibility is the majority of the place that you need to know as you're interfacing with a tax professional what's going on with this program. Then we'll go through the basics of how the credit's calculated, the filing process for the credit, and then the last and spookiest part, which is dealing with the IRS. I'll talk about current guidance from them, what audits look like, and just the general situation over at the IRS that I've been experiencing. So we're going to start with basics of the ERC program. So the ERC is the Employee Retention Credit. It is a one-time COVID-era federal payroll tax credit program. That's quite a mouthful. But basically what you need to know about that is that because it's a payroll tax credit, it's behaving within the tax code. So unlike things like the PPP or other grant programs where they're administered by other agencies, this is administered by the IRS, and it has to behave with the rest of all the tax legislation that came before it because it's baked into the tax code. And that's why these claims can get confusing, and this, the situations around with eligibility and things like that can get complex quickly. So how these are filed for are with payroll tax returns. They're Series 94X returns. Most people are 941 filers, so it's a 941X, and it is refundable. So even though it's called a credit, you're able to get it refunded as a cash refund, and it comes back in the form of a check in the mail from the IRS if you choose to have it refunded. So this next part, this is the number that gets bandied about a lot. The total cap for the program, so the absolute maximum that a company can qualify for, is $26,000 per employee. Now, that's extremely misleading. Having done a lot of this work, it is very rare for anyone to come anywhere close to that. And once we talk about eligibility, you'll see the reason why. But that's the total maximum cap for the program. And where that comes from is the total that you can qualify for in 2020 is $5,000 per employee. And then the total, they bumped the program up in 21 and beefed it up. So in 2021, the first 3 quarters are what's open for most employers, and you can qualify for $7,000 for those first 3 quarters for each employee. So that's $21,000. So that plus the 5 gives you the potential of 26. Now, the program is available. Like I said, it's a one-time program. So we're dealing with one overall window of eligibility where the program starts March 13th, 2020, and then it ends September 30th, 2021 for most organizations. Now, if you had a company that started after February of 2020, you can qualify into Q4 21, but I'm not going to address that because that's not most people listening. And then just so you know, even though this program's coming back from tax years 20 and 21, we're still available to file for it. For the 2020 claims, that deadline to get your filing in is April 15th, 2024. And then for 2021 claims, you have until April 15th, 2025. So we still have, several months left for the 2020 program, and then a whole year left for the 2021 program. And, for any tax practitioners listening here, you're probably doing the numbers in your head. That's too long of a statute of limitations. Because these are filed on payroll tax returns, it has a slightly different timing on the statute than normal income tax filing. So that's why it's so long. And then on top of that, this credit program is interesting because it's not just for active businesses. Not-for-profit organizations can also qualify for it as employers under very similar rules as the for-profit organizations. So now I'm going to talk about the basic formula of an ERC claim. How do you actually tackle whether or not this is an appropriate program? So we have that overall window that we're looking at where the program can potentially be eligible. And so the first piece that we want to determine is within that overall window that the program's open, what are the actual eligibility windows that the organization has? And I say windows because usually what happens is you can have 1 quarter will qualify in 1 year, maybe a couple months will qualify in another year. And basically, we're looking at the whole duration and picking out when is the organization eligible under the different testing rules that we have. So that's the first piece, is determining that eligibility window. That's where most of the problems happen in this program, and that's where we're going to spend a lot of time talking. So once you determine that eligibility window, then within those windows, you determine the eligible wages that were paid within the window. And then once you've got those eligible wages, then you calculate the credit itself, which for 2020 is 50% of the first $10,000 paid per employee for the year. So up to that $5,000. And then for 2021, it's 70% of the first $10,000 per quarter. So that up to $7,000 per quarter for the first 3 quarters. Then once you have all the calculations done and you've got your amended returns put together, then you apply with the IRS. It's a paper return process, and then you wait for them to process it. After that, you also have to consider, separate from the ERC filings themselves, there's an amended income tax return requirement because, like I said, this is within the tax code. And so it actually has to play with old tax returns, and we have to go back and amend those tax returns. And we'll talk about that separately from applying for the ERC. And then after that, usually the IRS will process, but then you have to wait because you're now within a statute of limitations for the IRS to come back and initiate an inspection. And so that can happen years after these filings are done. So that's the basic formula. We look for the windows, We look for the eligible wages, calculate the credit, apply with the IRS, file amended income tax returns, and then we wait if the IRS is going to inspect. So let me just give an example, because I think that gives good context here. So take an organization, they qualify for 1 quarter of 21 under revenue decline. So we've got 1 eligible quarter, and that's our eligibility window. And then within that window, say they had 2 employees where they were paying 10,000, which happens to be the cap, of eligible wages each for that whole quarter. So that gives us our eligible wage base. Then from there, you just do the credit calculation, which is we have $10,000 of wages that we paid to 2 employees times 70%, because we're looking at a 21 credit. That gives us a $14,000 credit, which would be refundable. So that would be the amount that comes back. And then you apply with the IRS, we fill out our amended 941 acts for that first quarter of 21, because that's the quarter we qualified for, through the mail. And then at some point, the IRS is going to process this, and we'll talk about the processing moratorium. It arrives, the check comes back in the mail sometime after New Year's for $14,000, plus the IRS pays interest on these. So because this is coming from 21, it's probably going to be somewhat significant. And then separate from that, the tax professional would make adjustments. So in this case, it would be an S corporation return to the S corporation return and personal returns, because remember, most people are a lot of people are in pass-through organizations. So you're going to have to amend multiple sets of returns for that $14,000, reducing the wage deduction that they took in tax year 21. And we'll talk about why you have to do this for federal and state, in addition to the ERC filing. So there's an example for you. And then the last piece is a couple of years later, or before they even process it, the IRS can send a notice requesting documentation. They can inspect the claim for accuracy. They can open a full-scale, audit on you. And this is something where we're starting to see changes in how this is happening, because the IRS is updating their enforcement policies. And they announced that they're going to be changing some verification processes for claims received after September 15th. So we'll talk about that too. So that's an overall example, so you get kind of the scale of what goes on with these. It's a pretty simple process, but the problem is each of these steps is riddled with a lot of pitfalls and complexities. And so I'm just going to go through each of those points, and we're going to hit all those red flags so that you can understand the components, all of these components and the complexities within the components. So the first, we're going to talk about the eligibility window and eligible organizations. Then we'll talk about eligible wages and wage exclusions. We'll talk about the total credit, which is the easiest part. Then the filing process, IRS audit, and substantiating documentation. Then we'll go through the amended income tax returns piece as well. So let's start with eligible organizations. So for the most part, if you're an active trade or business and you have W-2 wages, you will be considered an eligible organization for this. Now, if you're a municipal government, if you're an odd type of entity, you may not be eligible. That's something that the tax professional will help you to determine. This is also going to include 501c organizations that have W-2 wages can fall under this. Now, my big caveat warning, organizations approaching this is that there are special rules in this program for aggregating claims. And basically what that means is if you have multiple organizations that are triggering these aggregation rules, instead of doing all of the eligibility testing, which I'm about to talk about, at the level of that single organization, you now have to treat these 2 related organizations that need to be aggregated as if they were one for testing purposes. So it will totally change your claim eligibility. A lot of the times I see companies where they'd be eligible by themselves, but now they're no longer eligible when you consider them an aggregate, or vice versa, companies that weren't eligible by themselves, but then because they're being aggregated with other businesses that are, it can cross-reference. So the main pieces that I want you to watch out for with aggregated claims is if you have an organization that is held by a family or a closely related group of individuals or corporations, if you have complex equity structures that are shared between organizations, if you have some owners owning other businesses together, if you have employees that are being leased between companies, if you have no shared ownership, but you have companies that are being co-managed, or they're sharing critical business functions, they have kind of brother-sister relationships, or, arm's length kind of activities. And then if you have like parent subsidiary organizations, this is something you need to really consider to watch out for a potential aggregation. That's something that the tax professional will catch for you, but you need to be aware that can come into play here. So once you have an eligible organization, then we're going to look at, okay, what's our eligibility windows? And basically we have 2 tests for this program, and you start with one and then you go to the next one. So the two tests that we've got, the first is that your organization can qualify under a revenue decline. And then the second test, which is it's an either or, is that you can qualify under non-revenue testing. So it's not tied to it's not necessarily tied to revenue performance. And basically what you do is each test is administered for each quarter independently. And so once one passes, you're good. You've got an eligible window, and then you can move on and continue to test, do the rest of the testing for the rest of the quarters. So only one needs to pass in order for you to have an eligibility window. So practically speaking, then what I recommend is you just start with the first test, run through all your quarters, and then for any time periods that don't qualify under that, then you move on to the second set of testing. Because our first set of testing is based around revenue declines, and that's fairly easy to administer. It's very clean cleaner under audit, because it's, as long as your financials are correctly stated, there's not really much that could be wrong there. It's, either you're meeting thresholds or you're not. So the key components for the revenue testing is, and basically just so you know as well, the rules changed between tax year 20 and tax year 21 for this program. So I'll talk about the different rules for them. I'd say, the key component though is don't stress out about too much, because we will be providing some resources there. But basically what you're doing with both years is we compare the revenue performance in 2020 and 2021 back to the same time periods in 2019 on a quarterly basis. And so we're looking at each quarter during the pandemic and comparing it to what was pre-pandemic activity like in 2019. And then once you've determined that the relative change, then it can potentially qualify under how much of a reduction it is. Now, instead of trying to memorize the rules here, however you're engaging with, this content, there'll be an option to be able to receive resources. And one of the things we've put together is a tool, a calculator that's programmed all of these rules in. So you can play around with putting some numbers in and see if you have something that's going to potentially work. And, that doesn't replace tax advice, but it'll let you kind of play around with this and see if it works. So for 2020, the test is a start-stop. So basically how it works is the first quarter that you have that has a greater than 50% decline in revenues compared to its 2019 quarter will start your eligibility window. Excuse me. And then once you go through, you continue to test the rest of the quarters behind it. And then once it's less than 20%, that's when it will stop your eligibility window for that year. So if you're able to see the slides here, you can see this example, that first quarter, we've got a 50% decline, which is not enough. We have to have at least 51. And then the clock stops once it's less than 20%. So you can see for this one, it's Q2 and Q3 that are qualifying. So that's the 2020. And if you're listening to this and don't have the visuals, I recommend you get a copy of our slides from however you were engaging with this, and you'll be able to look at the examples, and that'll help you work through the basics of the rule. So for 2021, the rules changed, and they made the program much easier to qualify under revenue declines. So this is more often where it's going to be applying for your company. And for 2021, we're looking for a greater than 20% decline. So instead of 50%, which was rare, we're looking at 20%. And then there's a strange rule that they wove into this, and this is the main reason why I recommend just using the tool, is that if the quarter before the quarter you're looking at had a greater than 20% decline compared to 2019, that will also activate it. So for an example, and this only works for Q4 2020. If Q4 2020 compared to Q4 2019 was a 21% decline, it will actually trigger eligibility for Q1 of 21, even though Q4 of 20 doesn't trigger itself, because the 20 rules, remember, had to be 50%. So it's just really goofy how they changed that. Again, in the slides, we have an example where you can see it's all the same numbers, but with the 2021 rules. And basically, you've got the first two quarters qualifying because you've got that more than 20%. And then that third quarter is qualifying even though it didn't hit 20% because of that alternative quarter election rule. So in this case, they'd qualify for 3 quarters in 21. Now you can see Q4, they had more than 20%. But like I said earlier, the program window closed September 30th of 2021, excuse me. So that quarter is not going to be eligible because they were an existing business. Now, okay, these are, we know basically the rules of what we're looking at, but how are these numbers composed, right? What's considered, what do we need to add? What P&L accounts are we looking at here that need to be rolled up into this testing? So, like I said, this is a revenues test. It's a gross receipts test. And so basically, if you look at, if you have the slides material in front of you, there's a list of everything. But basically, the long and short of it is anything that was a revenue, considered a revenue, whether it's a normal revenue or not for your company, is going to need to be rolled up into the gross receipts testing. So if you earn your revenue in multiple streams, if you had unusual, revenue that only came in, for one quarter that you normally don't get, you need to add that in. And then because it's a gross receipts test, you're not netting out expenses from this. So you can net returns, sales tax, and allowances, but you do not net out the cost of goods sold when you go to do this testing. It's purely a receipts test. Now, the big exception here, which applies to most people, is that if you got any funds from the PPP, the EIDL, the Restaurant Revitalization Fund, or shuttered vendor programs, those are excluded from the gross receipts testing. And this is something that the IRS addressed specifically in their guidance, and that funds from the provider relief program, so for the medical grants, those are not part of the exception, so you would need to include those. Now, the red flag here is you just want to watch out if you're dealing with a smaller organization that has DIY bookkeeping. If they lumped those relief programs into normal revenue accounts, you need to pull those out. And then also if you had sales of capital assets, you want to reduce the gross receipts by the adjusted basis in the asset. And if you don't understand what that means, ask your tax professional. That's a number that's going to have to come from them. And for the nonprofit organizations, it's a slightly different, but basically it's, the same concept of anything that was considered a receipt needs to be added into this testing. Common things that I see missed is that if there was any kind of endowment or investment income that the nonprofit gets, that will also need to be included in this testing, even though it's not normal program revenue. But basically anything, that's contribution, gifts, grants, any kind of receipts are going to have to get lumped in for this testing. So common mistakes that I see people make here is that the reports that you run to do this revenue testing needs to be in the same method of accounting as the tax returns. So not just how you keep the books internally. The main report that most people will run is a Q1 2019 through Q3 2021 quarterly profit and loss statement, because that'll have all your revenue accounts on it. And we're looking at the calendar quarters, not fiscal quarters. You have to do the testing on a calendar basis. And this is the biggest one I see get messed up for accrual organizations. So if you're an accrual-based taxpayer, you need to watch out that your quarterly revenues are correctly stated. Because for a lot of these organizations, especially if they're smaller, they might do year-end adjustments for the accounts receivable or just different gross receipts, true ups for their tax returns. But then the quarterly numbers are not correctly stated. So you need to watch out and make sure that the numbers are correctly stated for all of the time periods you're looking at. And because we're comparing back to 2019, we can be dealing with some pretty old numbers here. So you just want to make sure that you have good integrity in those financial statements and the quarterly numbers that we're using for the testing all the way back to Q1 2019. So the pros and cons of this testing. Obviously, this is much easier to support an IRS audit because as long as you have good financial information and, reconciled bookkeeping, et cetera, it's much easier to just, prove that you've hit a decline. It's not tied to any other metric or causality. The way the credit is written is you don't have to prove that the decline came from COVID. It's just, do you have this decline? Yes or no? And so it's much easier to calculate and substantiate than the other testing we're about to talk about. Now, the major cons with the way that this was written is that it does not consider other P&L impacts. So if you had expense increases alongside stable revenues, that's not going to qualify you under this. And so because we're only considering gross receipts, it's a very simplistic metric for, medium to larger businesses or businesses that have complex revenue recognition. it's too simplistic for them. And so a lot of organizations that did genuinely financially suffer, that maybe don't qualify under the second set of testing, they won't be able to use this test. So it's unfortunate that that was done like that, but it is how it is. So if you have the slides, we have an example here of some numbers between years for a company, and you can see, in 2020, you're having to hit that 50%. So it's hard to hit that threshold. But then if you have that, that first quarter that's hitting that, and then you have a couple quarters that the performance was still down, you can qualify for more. It's that start stop. And then for 2021, we're looking at each of the quarters independently. And then that's going to give you, you've got each of the independent quarters, whether or not they qualify, and then that alternative quarter election that can trigger the quarter behind it too. Now we're going to talk about the second test, which is the non-revenue test. The revenue test is much simpler. And the core difference of the non-revenue testing from the revenue testing, and this is where all of the abuse of this program comes in, when you see all of these, crazy marketing companies and promoters and scammers, how they're able to leverage this, how they're able to function, and what they're operating under is abuse of this second set of testing. And so with this second set of testing, I think, to take a 30,000-foot view, what you want to realize is the organization, when you're not doing it based on financials, you're basically having to make a legal argument that your operations were more than nominally impacted by a binding government order on the ability of your organization to provide goods and services. So it's a very packed sentence there of like, that's what we're trying to prove. And so it's not a standard financial test. We're having to make an argument that's supported by operational, two pieces: an operational data that's showing an impact, and a government order that's showing a restriction. And so that sounds really vague to present it like that, because everybody had different situations during the pandemic of how much you were impacted by government orders. And so what the IRS did in subsequent guidance in this program is they gave us a couple of safe harbor tests. And basically what that means is that if you can beat these tests, you are passing in a black and white manner for eligibility of the program. But there's components of these tests. And so the two components, the first is that we have to show that the organization had restrictions in their operations during the pandemic that were coming directly from a government order. And that government order has to have certain characteristics. So you need that government order in hand. And then the second part is that the restriction was causing a more than nominal portion of the business to be suspended. And that has a very specific definition. So we have to prove that you have the restriction, that it was a binding restriction, and then that restriction was causing a part of the business to not function normally and hit a certain threshold. We'll talk about the testing. So how do you even start to approach this? Because I think it's easier to approach this in, practically, how do you actually do this assessment? So the first piece that I recommend, especially if you're not in the day-to-day operations of the organization, or if you're a tax professional watching this and you're not, you get annual financials and a couple conversations, but you're not in the day-to-day, is because we're looking at how did the orders impact operations, you really need to get an understanding of what was going on operationally and, productivity-wise, performance-wise, with the organization's ability to just do its normal course of business. And so we recommend starting with an operational narrative and getting a good sense of, okay, what was the pandemic like for this company? How did they have to change? What were things like before the pandemic? What was normal business like? Do we have an impact that's happening here from government orders? Or was it all fairly nominal and they didn't have to make too many operational changes? So that's the first piece, is get that understanding. And then once you have that, you need to go find the specific government orders that were causing those impacts and make sure that they have the qualifying characteristics. Once you have the government orders, then we need to prove that the government orders were having a more than 10% impact through some kind of operational data. So we know kind of roughly from our operational narrative of what was going on during the pandemic, but then we have to prove that narrative actually happened. And the best way to do that is with operational data. And then the last piece is once you have all of that lined up, the duration of those impacting government orders gives you the eligibility window for the ERC. Because remember, we're still at the point of trying to just determine if the company is eligible during this time period or not. And so you need all of those pieces in order to determine this. So the operational narrative questionnaire, this is something that we recommend you just work through with people who are in operations. If you're, if you have a fairly advanced organization where, you're just handling accounting functions, and you're not necessarily seeing what's going on in the warehouse or what's going on the floor. And basically what we're looking for here is comparing pre-pandemic activity to pandemic activity in what's the normal course of business for this company, and how was its productivity hampered by restrictions. And we're looking for things that are true government interference in the operations, not things that are just voluntary measures, not just general widespread economic disruption. We're looking for the government having a hand in the business's operations that were limiting what the business or the organization could do. Now, another piece that the IRS calls out specifically that you got to watch out for, especially for professional service organizations, is if the company did have a restriction, but was basically able to shift to a telework environment to meet that restriction, and it didn't end up having a more than nominal impact on the business. So, for instance, CPA firms, we tend to not qualify for the ERC under the government restrictions because for the most part, we can perform all of our work in a remote environment. So even though we couldn't, potentially do things in person, that teleworking loophole, kicks a lot of professional organizations out. So you need to watch out for that. But start with this narrative questionnaire because it will give you the scent to go on to go find that government order. This is where most people will just stop their analysis. This is really where you start your analysis. So once you have that sense of, okay, our operations, we weren't allowed to do X, Y, and Z for the first 4 months of the year, according to the foreman in the warehouse. I'm going to go see if I can find that government order. So let's talk about what a qualifying government order is. The first piece is that it has to come from a governmental authority. Most jurisdictions, this is state level. So for most jurisdictions, it was the governor that was issuing these orders. Sometimes you have local health boards. If you're in a metro area, sometimes it was the mayor. Parts of the American South, it was county-based. So it's coming from a government. It needs to be COVID-19 related, and it has to be limiting commerce traveler group meetings. And that this is the sticking point that a lot of people don't catch, and this is why you need a copy of the order itself, is that the order needs to be legally enforceable and binding. So suggestions, recommendations, best practices, or voluntary measures do not rise to the level of a legal restriction. This is something that the IRS specifically addresses. And so a lot of times what happens in organizations looking at this program is they did make a lot of operational changes, and those operational changes were requested of them by their governments. But then when you go back and you actually look at the government order, it's not legally binding. They're just suggestions. They're just recommendations. And so because they don't have that strong prohibitive restrictive binding on them, it's not qualifying under this testing. And so that's why you really need to look at the exact language in the government order, because the first piece is you need to determine the dates which it was applicable, because that's your potential eligibility window. You need to determine that they did have legal authority over the organization. And then you need the exact language of that restriction, whether or not it's rising to the level of a true restriction, or if it's soft language, which a lot of the times it is soft language, which is unfortunate because organizations still were abiding by it. But the way that they wrote this credit, unless it's a real legal restriction, it's not going to work for qualifying under this. So I have an example that's in the slides. It might be good to check that out. And basically it's a copy of what a real government order looks like. And you can see that it's coming from, in this case, this one was a church in Massachusetts. This was coming from a governor order prohibiting gatherings of more than 25 people. And you can see it's all very formal language. It's got the seal of the governor on it. It's in the jurisdiction that the client, was operating in. And then when you go through the order, you can see the language where it's, I hereby order gatherings of over 25 people are prohibited. So it's strong language. And then it gives examples of who and who it doesn't apply to. And, churches were within this. And so for the church, that was a binding order on them. So we have the binding order. Now, does this rise to the level of a full suspension? Depends, right? So that's the second part of the test. But the first part of the test is we've got this order that's got the strong language and it applies to them. And then we've also got the date range that we're considering. So usually at the bottom of these orders, it'll have an effective date until, the date it naturally expires. A lot of times we're looking at rolling orders and series of orders because they tend to get renewed or maybe they get slightly modified. And so it can end up being kind of a wild goose chase getting all of these government orders. And then it's got the governor's signature on it. And, just a special side note here is if you are going to be trying to qualify under this program, you really do need physical, you need your own copies of these, because a lot of state websites are now not supporting these anymore as they do their website updates, just because this program's, so old. We're looking back at 20 and 21. And so a lot of the government websites are now dropping these from their hosting. So you want to make sure you have a copy of this, because if under inspection, this is one of the first ththings that the IRS is going to ask for is a copy of your orders. So you need to have those in hand. And definitely don't just print out a news blurb from your local news agency talking about restrictions. You need the order itself. And a lot of people ask me, well, how do I get them? You just got to go on a wild goose chase. Usually you can get in touch with whatever the agency was that was doing it, and they can get you copies of things. But that's something that the practitioner who's doing this work for you should be doing. But that's the level of which you need things at, because just going by a narrative is not going to fly for the inspection. So once you've got that order, the second piece is, okay, we have this restriction, but say it was, the restriction on the church was just people had to wear masks. Is that really a restriction that's impacting us enough to qualify? And so once you have the restriction and you know what the language of that is, the second piece is, does this rise to the level of qualifying us? And so the IRS answers this question with 2 10% safe harbor tests. And basically what that is if you can beat these tests, the IRS says, yep, you have enough of a restriction or you have an eligibility window. And so the first test that they give is for a full or business segment closure. So for instance, for the church, instead of saying if 25, gatherings of 25 people or more are prohibited, if they just said straight, any religious services are prohibited, that would be a full closure, right? Or maybe a partial closure if they do other activities like a food bank that wasn't restricted. So that first one is the nominal portion test. Now the second test, and this is where most people get lumped in, is when the business segments are impacted but not completely shut down. And so that's the nominal effect test. And basically for this, either one of these can work for proving as a qualifying impact. And so I'll talk about these two tests in more detail. The first one is when you have the nominal portion test, and that's when a portion of the business, so a good example is indoor dining for a restaurant, because a widespread one that qualifies into this, say for the instance of a restaurant, they've got indoor, outdoor, takeout, they have different segments of their business, and the government restriction was closing the indoor, which is one segment of it. So when a portion of that business is closed, or a full suspension of the business is closed, obviously that qualifies. But when you have this, when you have a portion of the business closed, you just need to demonstrate that the portion of the business that's being closed is a big enough size that it had a more than nominal impact on the business. And so what that means is you just need to show that that portion of the business represents at least 10% of either the gross receipts from that part of the organization compared to the total in the same quarter of 2019. So we're looking at pre-pandemic activity here. Or that the labor hours done by employees of that part of the business is at least 10% of the total hours from all employees within the same quarter of 2019. So let's just go into examples because that's easier. So for the restaurant, you've got a restaurant with indoor dining that on a quarterly basis, indoor is about 50% of their sales in 2019, so pre-pandemic. And they had a state government order that was shutting down all indoor dining for 4 months. Now, let's say that they pivoted to takeout and their revenues were actually up. Doesn't matter, because the way that this credit was written and the way that this safe harbor was given is that we just need to show that the restriction on the normal operations, when you look at 2019, that it was at least that 10%. And so for this, because the portion of the business that was closed is more than 10%, it's 50% of their 2019 activity, the duration of that 4-month closure is the eligibility window for the ERC, because we've got that government order And then we've got, we're showing that it's a big enough segment, and they had to do that that operational shutdown. Now, for most people though, and most organizations, you didn't just have a straight shut, you didn't have a straight closure of a segment of your business. It's more things like, we had to do social distancing. We had to, the way that they wrote the restrictions, we really had to limit how we were normally meeting with our customers, or, we couldn't go to trade shows. There's all these other impacts that are being considered. And so there's a second set of testing that's called the nominal effect test. And basically that's saying, well, we didn't shut you down, but if we had more than a nominal effect on your business with these government orders, then you can have an eligibility window then. And this is really the frustrating one, because unlike with the previous, where you just have to prove that the business segment was big enough and that it was really forced to be closed or suspended, with this, it's completely idiosyncratic. And basically what we have to do, and this is the exact language from the IRS, is we need to show that the government order was causing an impact of a 10% reduction in the employer's ability to provide goods and services in its normal course of business. So that last piece there, we're looking for a 10% reduction in the employer's ability to provide goods and services in its normal course of business. So that's going to be completely idiosyncratic to the organization. And so that's why we recommend start with that operational narrative, because then you can see what our normal operations look like. How many jobs can we get done a day? How many labor hours do we do per job? How many people are we allowed to have on the floor? How many people are we do we normally have in the office? What do normal operations look like? What are our relative inputs? What are our relative outputs? What's our relative productivity level? How does that work normally? And then when you have these restrictions in play, how do all those metrics change? How did we have to change things because of these government orders? Not anything that was voluntary, not anything that was just, reduced demand from customers or chaotic things, but direct, the government said we had to do X, Y, and Z. And so we were losing 15% of productivity, 20% of productivity because we had to follow these rules. That's what you're looking at. And so that's how you're making your argument. You say, here's the government order, here's the restriction, here was our normal activities, here was our activity level under the restriction, and you can see the delta there is more than 10%. So we have a qualifying window under this nominal effect test. So what's the exact data that you need to actually prove this? It's going to be completely idiosyncratic to the organization. We recommend, because 10% is really not a big ask. It's not like they're asking you to show a 50% productivity decline. They said it has to just be at least 10%. Our recommendation is to get that in operational data, because if your organization was really being impacted by this government order, somewhere in your operational metrics will be showing a 10% decrease. And so we really recommend the best practice is you want to have quantitative support to make your argument, and it's not just a narrative, because remember, it's one thing to do these calculations. It's another thing to be able to successfully defend yourself in an IRS examination. And if you're just relying on someone else's determination of that you're being reasonable, or that, oh, this makes sense, versus, no, we have data to back this up, that we really were being impacted, that puts you in a very strong position here, rather than just relying on someone, a revenue officer thinking that you're being reasonable. So let's just get into some examples of kind of how this can work. So for this first one here, this was for a meat packing plant that we were looking at. And basically they were forced to do all these sanitization requirements from their local health board. And so we looked at their pre-pandemic productivity, and then we looked at their pandemic productivity, and you could see that their job completion times are increasing by 15% during all these sanitization requirements. And that was directly being caused by, they were losing a lot of production time because they were having to do extra sanitation. So there you go. That's more than a 10% decrease in productivity. And we have orders from the local health boards. So that's going to be, that duration of that restriction is going to be qualifying for them. Another example, warehouse with pretty tight spacing. Normally they could have, a full crew of people on site, but then because of the social distancing requirements, they had to space out all their workstations farther away. And so that caused delays in their fulfillment, which increased their labor time per order by 15%. And so because we're over that 10% and their productivity decreased by more than 10%, directly being caused by the social distancing requirements and reduced floor capacity, that's a qualifying restriction for them. And so they'd have an eligibility window. Now, if you want some examples, if you've got the slides, there's some specific industries that the IRS talks about examples for, which include restaurants, retail businesses, hospital, grocery store, large retailer. If you're in any of those organizations, I recommend you take a look at the slide and take a look at the example that the IRS gives of what's going to work. Now, you've noticed that I have not talked about supply chain disruptions because I'm now pretty much at the end of what's going to be qualifying tests for this program. Now, I'm just going to simplify this because, just to be completely transparent, I'd say at least 99% of supply chain qualifications don't work. And the reason for that is, in order to qualify under supply chain disruption, you basically have to apply all the previous impact testing from the perspective of the critical supplier, and you need to be showing that a government order is causing the disruption directly. So you still have to get a copy of that government order, and you still have to prove that the disruptions are beating the 10% test for your company. And on top of that, you also have to prove that the goods or materials that you get from this supplier are unable to be obtained from another supplier. So, a lot of times people, I get this question a lot, especially people from the construction industry say, well, I couldn't get lumber. It's like, well, if you drove around to every Home Depot in the tri-state area, could you have bought it? Was it really legally restricted from you, or was it just not, unavailable general disruptions? So really what we're looking at if you are going to try to qualify under supply chain is that it's being caused by these government orders. And I would recommend, if you're even going to attempt to approach this, there's a reference in the back of this slide presentation to the recent IRS guidance on supply chain restrictions. I think it's pretty user-friendly for anybody to read. You'll want to thoroughly read that and thoroughly consider that before you even attempt to try to qualify under supply chain. This is a completely abused provision, and it's very inappropriate for most situations. So I would say just pretty much avoid it. It's almost never going to work. So once you've done all that testing, then the eligibility window is going to be when you're beating those tests, and it's going to be the specific range of the order. So if the order was in place from March 17th, 2020 through April 5th, 2021, or you have rolling orders that continue to renew, that gives you your eligibility window for this program. So you can see why there's so much abuse with this. If people just say, oh, well, did you have a government restriction? Oh, yeah, we did. Okay, great. You qualify for, X number of quarters without actually doing all this due diligence behind it. So best practices here. First one is you need to watch out for aggregated claims. So if you haven't had that assessment properly done, watch out for aggregated claims. That will totally change how you apply these thresholds. And you also need to watch out for businesses that are operating in multiple legal jurisdictions, because you might have, operations in this state were not impacted, and then operations in that state were impacted. How do you blend that together to see whether or not the organization qualifies? So those are common ones that can be a problem. You'll want to question any practitioner that's unable to produce specific government orders for eligibility. And the reason for that, like I said, is you need those date ranges, and that's the first thing that the IRS is going to ask for. So as you can tell, this requires some legwork, but it's a real pathway for eligibility. When you consider the potential numbers here, it can be very much worth all this legwork, and you can get it to be proved in a black and white manner if you're beating those 10% tests with the operational data. But really the key here is you need to substantiate, because at the end of the day, you as the taxpayer, your organization as the taxpayer, is making an argument to the IRS that you qualify for this program. And so the burden of proof is on you that you actually do qualify for it, and not the burden of proof on them to disprove you. So you need to really make sure that you've got it really tight. So we talked about eligibility window, and like I said, that's the majority of the presentation. We're going to breeze through the rest of these because, for your organization, the majority of where you're interfacing with a tax professional on this is that eligibility window. And especially under the non-revenue, it's those questions. That's where you're going to be interfacing with the tax professional. So we'll talk about the eligible wages next. So eligible wages, I'm not going to talk about employers with over 100 employees in 2019 because there's different rules for you. If you're anywhere close to 100 employees, you just need to have a tax professional assess your situation because you're playing life and death with potentially millions of dollars of tax credits. But for everybody else here, the first 10,000 of wages paid within an eligibility window of 2020, and then the first 10,000 paid in each of the 3 open quarters of 21 per employee are potentially eligible. Now, the general principle of eligible wages is we're looking at Medicare wages paid plus health benefits, less wages used by other aid programs, so PPP wages. A notable exception is the tips credit, which is specifically allowed to be double dipped. And then you also need to remove wages for non-eligible persons. Now, in the reference slides, there's a full big list of what qualifies as eligible wages and not, so I recommend you reference that. And I'll talk briefly about some notable exclusions here that people often miss. So if you have a partnership organization, guaranteed payments to partners are not technically wages, and so they need to be removed. The second one that this applies to a lot of people is if you have wage payments to related parties. This hits a lot of smaller companies, and I'll talk about who's considered a related party. And then the last piece is if you have PPP forgiveness proceeds within an ERC eligibility window, and this is also going to apply to the Restaurant Revitalization Fund, that the portion of the fund, the grants that were used towards payroll, those proceeds need to be excluded as well when you have overlapping time periods. So common one that gets missed, and I'm going to breeze through this because this is something your tax professional should catch, is the related parties. And basically any wages that are paid to owners who are indirect or direct. So if you have entities where you have, say a C corporation, and then some of the shares of that C corporation are owned by an S corporation, and that S corporation is owned by individuals, it flows down to who the individuals that are getting the benefit. So basically you boil it down to who the actual human people are. And then anybody that's got over 50%, once you boil everything down, are not going to qualify for the credit as eligible wages. So a lot of your smaller organizations where you've got, if you've got a single member S corporation where it's just the owner of the S corporation is the wages, they're not going to qualify because they're over 50%. And then in addition to that, any wages to family members, to people who are in that over 50% ownership category, are also not going to qualify due to the attribution rules. And then on top of that, if you have shared family ownership, it will attribute to the other members of the family for calculating that 50% threshold. So a good example is if you have a husband-wife duo who own a business 50-50, you would be tempted to think, oh, well, they're both not more than 50, so they're not majority owners. But in reality, their ownerships have to be attributed to each other, and so they're considered 100-100 by the IRS, and so neither of their wages would qualify. Now, who's considered related individuals, it's basically anybody who's got a familial relationship by blood or marriage. There's a list in the reference slides. A common one that people can miss is if you have somebody other than a spouse whose abode is with the taxpayer. So if you even boyfriends and girlfriends can get pulled into this, or stepchildren, things like that can get pulled into this. So you just want to review that slide if you're concerned. This is something the tax professional should catch, but just so you know. There's also an example. This is more for the tax professionals in the audience who are interested in this, in the reference slides directly from the IRS, of how family attribution works when you have multiple family members owning, and how you have to add up the ownership interest. So examples in the slides as well. So I'm going to talk about, this is another piece that gets missed as well, is, we talked about who related parties are and that their wages need to get pulled out. And then the other thing that hits 90% of the cases that I deal with is PPP proceeds need to be excluded when you have overlapping eligibility windows. Now, the original rules for the ERC were that if you even participated in the PPP program, you just could not participate in the ERC program, period. And that's how it was originally written. This was subsequently changed when Congress realized that basically nobody was going to use the ERC because the PPP tended to be better. It was a better amount of money compared to the ERC. And so most people would just go straight for PPP. And so the Congress realized, oh, we're basically just disabling this program. So you guys can do both now, but just make sure you're not double dipping. So if we're already paying you for PPP, if we're already paying you for these wages, we're not going to pay you again for the ERC. And so that's the caveat there. So I would say, practically speaking, without going into the details of how you do a PPP exclusion, which it basically just applies when you have an ERC eligibility window that overlaps with a PPP forgiveness window. And so what that looks like is, say you have PPP 1 that happened during 2020, and that forgiveness window is, the middle of summer. And then you also had government orders restricting you during the whole year of 20. That's going to give you your, you're going to have an overlapping window there. And so you need to do some allocations. I'd say, practically what you actually need to know about how all that works is 90% of the cases that I deal with have both. They're going to have PPP overlapping with their ERC, or they have PPP and they have ERC. And the ERC program, for the most part, 90% of the time is still beneficial. And this is especially true in organizations that have highly compensated employees, where sometimes once you do the allocation, you don't even have to, you're not even losing any of your ERC, because just the way that the wages work out and the allocation works out, it doesn't actually decrease it. And it's one of the most complex accounting parts of what goes into ERC calculations, is having to do these allocations correctly. So what you just need to know, though, and the red flag I see is people say, oh, well, we got PPP, let's not even consider ERC. That's not the right answer. If you got PPP, but you had revenue instabilities and you had some kind of operational disruptions from government orders, you should still get your organization assessed for this, because most of the time the PPP is not going to completely remove the ERC, and it's usually still beneficial. So that's the piece that you actually need to know. All right, so we talked about eligible wages. We talked about total credit is next, and then we'll go through the IRS and amended income tax returns piece. So once you have that eligible wage base of people who, you've got that window, what were the wages paid within the window? Take out the PPP, take out the family members, take out the partner guaranteed payments, take out anything else that needs to be taken out. We've got our eligible wage base. Here's how you calculate the credit. 2020 credit is 50% of the first 10,000 of eligible wages paid per employee. 2021's is 70% of the first 10,000 paid per quarter per employee. So you do that 3 times. And that's it. That's how you calculate the credit once you've got that eligible wage base. So let's go back to the example that I said at the beginning, because now you have a lot more context, right? So remember, our first step was determine that eligibility window. This organization only qualified under a revenue decline for Q1 21, which is not a surprise, because the threshold went down to 20, so it tends to be easier. Then in that window, they paid 2 eligible employees $10,000 of eligible wages each. Say they had 5 employees with 3 or family members that had to get pulled out, so we only get it for the 2. And that's your eligible wages. So it's the 10,000, the credit is the 10,000, which happens to be the cap, times 2 employees, times 70% gives you that $14,000 credit. And then from there, now we're going to talk about the back end of this. So we've done all the, legal determinations and calculations, and we're getting our paperwork in order. How do we actually file for this thing? So for them, it's a Q1 21 filing. So we're going to file a 941X with Ogden, because they're, I'm pretending they're on the West Coast and that's their filing center. And you send it in through the mail. And then the check arrives, hopefully in 2024, we'll see with IRS processing times, for that $14,000 credit with some interest tacked on. And then we're also going to talk about the amended income tax return piece, which, like I said in the example, is S corporations. So you've got a bunch of returns getting impacted, and we're having to go back into 21, so these old tax years. So before I talk about the filing piece, let's talk about the amended income tax return piece. Filings are done for ERC on the payroll tax, amended payroll tax returns. But in addition to that, income tax returns will also need to be amended. And how they'll have to be amended, this is something your tax pro should handle, but that the credit amount is going to be reducing the wage deduction in the year of the credit. So if you have a 2020 credit, you need to reduce the wage deduction that the organization took in 2020 by the amount of the credit. And this requirement's coming from, and I reference this specifically for the tax professionals because they always ask me, they really want to make sure that they absolutely have to do this because it's such a pain, is IRC Section 280CA rules kick in. And it's discussed in IRS Notice 2021-20 question 60 specifically. And it applies to both cash and accrual-based taxpayers. So even if you're going to be getting the funding in 2024 and your cash basis taxpayer, where normally you would just recognize that in 24, tax credits don't behave like that. So that's why you have to do it. And so that's why I recommend for any organization, before you do an ERC filing, have an income tax forecast on how is this going to impact those amended income tax returns, and a projected cost of what it's going to cost you to have those returns amended. Because especially if you've got a pass-through organization where you've got S corporation returns, federal and state, and multiple owner returns, federal and state, and maybe multiple years, 2020 and 2021, you could be easily walking into 10 returns that now have to be amended to go after the ERC, and that might make it not worth it. So you need to know that before you do this filing. Now, on a practical level, I have some people say, oh, well, if I'm going to have to pay tax on this, is it even worth it? Mathematically, you're losing a deduction on $1. So it's usually just a haircut for people, but it can be a painful haircut. And then the next question that everybody always asks me is, well, when do I have to do this? Now, the language that we have from the IRS is that it needs to be within a reasonable amount of time from the original amendment. What is considered reasonable is up to the tax professional's discretion, especially given that we've got some massive IRS processing delays, which I will talk about shortly here. Many tax professionals opt to wait. Now, just note, the longer you wait to do these amendments, you are accruing interest and underpayment penalties. But like I mentioned previously, the IRS pays interest on these claims. And so usually the interest nets out on what they pay you on the claim to the underpayment interest and penalties. So usually that works out. That's why most people wait. But you really need to consider the facts and circumstances for the organization that you're looking at of when it's appropriate to do these amendments. And it's going to come down to what's going on in that individual situation. And that's why you need to get a tax professional involved with these, and do not execute one of these filings before you've talked to your tax professional, because it's not a standalone filing. It's baked within the tax code. And so your ERC is going to interact with all of these other pieces, and you need to know the full impact of that before you do it. So I give an example for the tax professionals. A lot of the tax professionals that get really frustrated with this requirement, something that I would just have you consider is that most of the time when people are qualifying for the ERC, they had poor financial performance during 2020 or 21, what the qualification period they're qualifying for. And because most people are operating in pass-through entities, to lose a deduction in a year where you had poor for financial performance, and then the money comes in tax-free in 2024, which hopefully is better financial performance, that's actually a tax arbitrage. You're making some money on that. So a lot of the time, even though it's administratively annoying, it's actually beneficial for the organization to have this treatment, because I'd rather lose a deduction on 10 cents on the dollar when we were in a lower bracket. And then when the money comes in 24, I can spend that same money and get a 30 cents on the dollar deduction. I'm making 10 cents on that arbitrage, right? So just consider that with the administrative frustration with this, but just know that it is, it's a legal requirement in the program. And, you really just want to consider what needs to happen with these before you do it. So talked about the amended income tax return piece before the filings, just because that's, you need to really consider the full scope. Once you step in the ring with the IRS with these, you need to know the full scope of what you're in for. So now we're going to talk about filing process, IRS audit, substantiating documentation. We'll talk about the moratorium and withdrawal programs really briefly here. Now, before 914, these are paper payroll tax returns. There was no electronic method provided for us. And they, I recommend that both the tax preparer, and the officer or owner of the organization is signing. I would be very concerned if I had somebody, giving me calculations and not being willing to actually do the filings. I get a lot of people where they say, oh, well, the company said the payroll provider needs to do this. No, they do not, unless they're a PEO, which if you don't know what that means, you're probably not using your payroll provider as a PEO. The person who prepares the calculations can also prepare the returns, and it gives the IRS a trace on whose hand was actually involved with doing these calculations. So be a little skeptical of people who don't sign for their work. And then these are mailed to the IRS. We recommend certified. Wait times used to be 3 to 4 months over the summer, and certainly longer for larger claims, which went through a second level of inspection. At that point, once the IRS processes a return, then they either issue you a notice because something's wrong and they're not going to pay it out, or they issue you a notice and then send you the checks. And then the checks come back to your address of record, which it's very important to confirm you've got a good address of record, because most of the time, organizations are filing all these payroll tax returns electronically. So if you have an old address, that you had 5 years ago that doesn't work, you'll want to know that because that's where they're going to send a check to. Now, after 9/15, they announced a processing moratorium. What does this actually mean for organizations that are still eligible for the program and haven't done it yet? Basically, that the IRS is just retooling their administrative processes and they are waiting until after December to start processing again. It's going to create huge backlogs. They're still in the process of a settlement program if the organization filed for a claim and then needs to basically, they filed for a bad claim and need to come clean with the IRS. And they did announce the withdrawal option, which is, kind of beyond the scope here, but just know that there are ways to remediate bad claims and that for any claims that received prior to the moratorium, they're still going to be processing. So if your claim was date stamped before 9/15, the IRS has you in a processing queue. In my practical experience, I think they've basically stalled all processing at this point. So, just know that if you do apply for the ERC, don't count on it coming in any sooner than 6 months from now. It's just a real mess over there administratively for them. And then there's a link in the reference slide to the actual announcement if you want to see it. Some of the fraud numbers are kind of spooky, and I think are going to continue to get spookier. So what does this actually mean? It doesn't end the tax credit. It's just the IRS is pausing processing. And the key piece that I would recommend people do is, like I said, for 2020 claims, that statute of limitations is coming up in April 15th of 2024. So you don't have a ton of time left. And especially for most organizations where the 2020 claims, you're really looking more at those government orders a lot of the time because that's when those restrictions were in place. And, the revenue decline rules were so harsh in 2020 that really most organizations are looking at the government restrictions for 2020. And it, as you could tell from all the, discussion of the testing, it takes a while to button those up, right? You need government orders, you need operational data. There's a lot of back and forth. There's a lot of collaboration because you're having to basically put together a whole legal argument. And because that statute of limitations is going to run in April 15th, I would not delay the process of getting your organization assessed just because the IRS is, not processing these right now. And as far as we know, that there's no guidance that they're going to be changing the actual administration of how we submit returns. And their current guidance as of last week, they put out a big webinar for what they're doing with ERC. They said, continue to submit claims that are legitimate. Just make sure that your claims are, truly legitimate and that you're, crossing your T's and dotting your I's, but they want you to continue to submit even though they're not processing. And then the sooner that you submit a filing, it puts you farther up in the processing queue. Unlike if you wait, it just, gets you in line sooner for processing. So common issues with the IRS filing process, you really want to make sure that the address of record they have is correct and get that corrected before you do an ERC filing because you do not want them sending checks to bad addresses where it's not going to get to you. It's a nightmare to redirect checks with the IRS. And then you also want to make sure if you update your address of record that you update that with your payroll provider and anybody else who's doing filings for you because you don't want it to revert to that old address again. We recommend anytime you have any kind of correspondence with the IRS or any kind of government agency, you want to send that certified so you have proof of your mailing. And basically, just so you know, they give no updates on timelines of when they're going to do things. Basically, if you call in to try to get a status update, the only thing they'll be able to tell you is whether or not they have a return that they're waiting to process, or if it's been selected for examination, or if it's been processed. So they can't give you an update of, we'll get, you're about 3 months away. Nothing like that. And then especially after 9/15, every time I talk to them, currently there is no updates. It's it's like a black hole over there. So just don't, what I tell people with the ERC, it's really unfortunate. It was designed to help keep people on payroll, but the way that it's been administered is you've just got these really long delays for the payouts, so that the program's just not operating how it was designed to operate at all. And so when you do an ERC filing, it's like getting, like a lottery ticket. A check in the mail that's going to show up at some point is better than no check in the mail that's never going to show up. But don't hang your hat on getting these funds back in a specific time frame. And then if your organization used a PEO, all of your filings will need to be completed by the PEO. And that's because all the original filings were done under their EIN number. Now, if you're not sure, look at your payroll tax returns. If it's your organization and your EIN, then you can, you don't need the payroll company to execute this for you. And if anything, just as a side piece, I would recommend, if your payroll company is suggesting that they execute all of these, get your tax professional involved, get a tax professional involved, because just in my professional experience, they're quick to do filings without doing all the due diligence of the eligibility work. And that's the main problem that most people have. Like you could see from this discussion, it's fairly easy to do a calculation, and just amend some returns. It's what's more difficult is making the right judgment call on eligibility. So definitely you'll want to get licensed tax professionals who have experience in this program coordinating with that, and don't just let your payroll company file based on you thinking that, oh, maybe we're eligible for a couple quarters and this sounds good. Really be careful with it, because you're really playing with fire with this. And that leads me nicely into the next segment, which is talking about the IRS audit. At this point, we don't have statistics really, because the IRS has just, in the last couple of months, started opening up the examinations. It took them a long time to get specialized teams trained, and I think they're still working on their audit methodology of where they're focusing. I think they're really sidetracked right now because of the level of fraud in this program. That's really their first emphasis, is going for just the really wild, erroneous claims and the fraudulent claims and the bad providers. So I just tell anybody who's going to file for one of these, just assume that your claim is going to get audited and be ready for that. Because when you think about it, how often do you get a couple $100,000 back from the IRS, right? That never happens. So this is just going to be a big area of scrutiny for them, because it's big chips on the table for them, right? If they can show that you're not eligible or your arguments aren't quite good enough, that's the easiest way for them to claw back these resources, that enforcement can do. And so they're going to be incentivized to really heavily pursue this program, just because, it's been abused so much, and you have people that are doing these filings without doing the due diligence. So just assume that you're going to get audited, and then you have nothing to really be worried about if it does happen. Now, audits typically have a 3-year statute of limitations. I personally expect this to get extended just because of the abuse in the program. Now, there are other special rules where if you have, if they think fraud's at play, it changes your statute of limitations. And then some of the quarters for this program are 5 years. But I just expect Congress to get involved at some point once the full scope of the erroneous claims and payouts has been figured out. And I expect Congress to get involved in this, probably to get extended. So this could just be a long ride for everybody. So what's a good substantiating documentation list? If you go in the slides, I'm not going to bother reading through all of this because we're a little bit over time here, but you'll want to read through, and basically in the presentation materials is a preparation and substantiating list. And that has basically everything, the majority of the things that you're going to want to have before you do an assessment, and also what you're going to want to have saved as your substantiating documentation. So there's this list here. And then the last piece I just want to emphasize is, if you're going to try to pursue qualifying under non-revenue, so qualifying under those government order restrictions, just make sure you've got copies of all those government orders, and you also have all the operational data showing those impacts of those orders, and really just make sure that you're taking that requirement seriously. Now, substantiation per the IRS, there's another slide in here that's directly from the IRS Notice 2021-20 question 70. This is the direct language from the IRS that you can review, but it's obviously wrapped up in the previous slides with what our normal recommendation is. And then the last one after this may not be the most current, but it's the most current to me, is the IRS IDR, the information document request. So this is the scary notice that they send you that lets you know they're actually taking a look under the hood. So you can take a look at that as well, of what they tend to be asking for now. Now, this is something that they might, I assume is going to update over time. So let's talk about some red flags, because I think we've hit a lot of technical points here, and you're probably kind of swimming in all this. And just know that, you can go back and reference slides, which I recommend. And you can also go back and reference the different segments where I'm talking about different topics. But when we take a step back and we consider this program at large, the main things that I want you to avoid are twofold. The first is, we're in a Goldilocks situation. So you don't want to take too much. You really don't want to take too much. And on the flip side, you really don't want to take too little too, because as an accountant for an organization, You want to make sure that your organization's being competitive, and if you're eligible for something and the organization's legally entitled to it, that you're doing it. So you don't want to take too little either. Though the program's completely optional. And so if you're just genuinely, if you're the owner and you're genuinely uncomfortable with it, don't do it. I tell people that all the time, like, just know what you're getting yourself into. And if you're not comfortable with it, then just don't do it, because you don't have to do it. But if you are going to do it, you want to make sure that you're maximizing it, right? So the first section I want to talk about is the overclaim, the taking too much. So common red flags that I see, and this is for organizations that have already done their filing, right? So if you filed for all quarters of this program under the non-revenue test, that's a huge red flag. Most jurisdictions dropped their restrictions either in 2020 or, like, even in California, the really harsh restrictions dropped, mid Q1, Q2 of 21. So if you are working with somebody who said you qualify for government restrictions under every single quarter, that's highly suspicious, because it just doesn't happen very often. If you filed with a supply chain disruption, I can just tell you your claim is, probably 90% chance that it's not correct. So what huge red flag. If they filed for your credit without your PPP forgiveness application, or no inquiries about PPP forgiveness time period, also red flag. If the person that you dealt with was not a credentialed tax professional, if they were a salesperson, if they were a marketer, if they come from a completely different industry than the tax world, also a huge red flag, because these are really nuanced. And like I said, it behaves within the tax code, and it's complex. If they didn't request data proving the impact of government orders, if they just asked you a couple questions and, nodded their head along with you and said, oh yeah, so it sounds like you're eligible for all these quarters, then that's not going to cut the mustard with an IRS examination. You definitely need some kind of operational data. That's a huge red flag as well. If they were unable to produce government orders, that's also going to be a huge red flag. If there was credit given for related parties, so if you're seeing owner wages get included, red flag. And then if they didn't make inquiries around business ownership and the potential of an aggregated claim, that's also a big red flag, because like I said, that'll completely change how we do all the testing if I'm now having to look at two companies at once instead of one company, right? So red flags for overclaim. Red flags for underclaim. So these are for organizations that maybe did do their filing or haven't approached it yet. The first is only considering revenue declines. So I see a lot of organizations where they'll only consider the revenue declines and not consider the government restrictions at all. So you're missing a whole second half of the program. The second one is not knowing that alternative quarter election. I see this missed all the time for the 2021 program. Best way to catch that is use the tool that we'll provide. If you plug your numbers in, you'll be able to see if it's potentially appropriate. That's the easiest way to check that. Third, and the most common one I see, is just not doing an eligibility assessment to begin with. So I see a lot of organizations where they'll say, well, our annual financials were up. No need to explore this. We're just going to move on. When you're considering that, like in my example, we had 2 employees generating a $14,000 credit for one quarter. You want to do more due diligence than that. And so how do you know if you've had an assessment done? How do you know if your tax professionals assessed you? First piece is, did they look at quarterly financial statements? Did they look at 2019, 2020, and the first 3 quarters of 21 on a quarterly basis? Do they have access to that, to those gross receipts numbers? The answer is no. Then they didn't do the revenue testing. And then the second one is, did they have a conversation with you about how did the government interact with you during the pandemic? Did you experience any operational restrictions from government orders? And if you haven't had that specific conversation with anybody, then you haven't been assessed. So that's the most common miss I see, is people just don't have an assessment done. Next one is over allocating the PPP exclusion, basically wiping out all ERC within a forgiveness window. That's one that's harder for people to catch, but I would just recommend, if you're seeing that a whole window of wages is being wiped out, they might be incorrectly applying that allocation. That one's just tough for people to catch. And then the last one is same thing with the aggregation, right? So if they just looked at one company, but really that company needs to be considered in part of a portfolio of companies that are operating in brother-sister relationship, they haven't really been assessed. So those are the pieces you need to watch out for the underclaim. Now, I'm going to go quickly through this. What do you do if you had an incorrect filing? IRS recommends, if you were subject to a fraudulent or negligent claim, think you've been scammed, or you've had, fraudulent work done, there's a form 1424-2 that you can report to them. They do recommend that, especially if whoever was doing it didn't sign those returns. There's no way for it's really hard for the IRS to find those people to actually help with the cleanup process. So there's a link to that form there. But basically, if you have an incorrect filing, first step is you just need to recalculate the claim. What are you actually eligible for? And then you refile the amended returns based on what you're actually eligible for. And then you pay back the excess credit, or you claim the additional credit if you had an understatement. Now, they have a settlement program that's to be announced, but the current process they request is file a new set of amended returns and just, true up with us what it actually should be. And then you also want to reconsider if amended income tax returns were filed, do those, if those need to be amended again because your claim is being adjusted. Now, the withdrawal program, I'm just going to recommend at this point. I have a separate video about it, but basically what you need to know is if you have quarters that are not processed yet, that you believe need to be basically rescinded from the IRS for whatever reason, they have a program to withdraw them and basically returns your account to as if you never filed those returns. You can go to irs.gov/withdraw my ERC, and that has the instructions of how to do that. I recommend if you have a dubious claim, instead of dragging your feet with it, just withdraw the claim and then start the process from scratch. Because you don't want to risk getting inappropriate refunds issued to your organization than having to deal with the cleanup from that. It's much easier to just wipe the account clean, start over, and then submit correct filings. Now, the last piece I'll talk about here, we have in the reference slides a full summary of the IRS guidance received, which includes all the IRS notices. Any tax pros in the audience, the most substantial one that you'll want to look at is IRS Notice 2021-20. Anybody who's attempting to do this program themselves, you need to read all of these. And then at the bottom, we've got just general IRS guidance. They have an eligibility checklist, eligibility chart. Honestly, I don't find them super useful. This presentation, I think, is much more in the details and proactive than what's on those. And they have an FAQ page, which has, some good information on it, though it's not binding to them. And the last piece, anybody considering supply chain, you need to read that IRS memorandum link that's going to be in the slide materials. Anybody who's going to consider touching supply chain, go for that. So that's the presentation. And basically, let's take a look and see, did we get any Q&A that needs to be addressed at this point?
No, nothing at this point.
All right, great. So if you have any questions that you need to submit, you can get in touch with our admin team. But like I said, we can't give specific tax advice. And then however you're engaging with this content, there'll be an opt-in in the show notes or below, and you'll be able to get a copy of that revenue testing tool, a copy of the slides, which have all the reference materials, and additional resources that we provide over time. And if your organization is in need of an assessment, you can visit us using the links in the show notes to get in touch. And also, if you're a tax professional, because I know a lot of people listening are going to be tax professionals, you can get in touch with us if you'd like to learn more about how we support other tax, as a CPA firm, we support other tax professionals with these filings for their clients, doing a lot of the due diligence work, et cetera, for this. So if you'd like to get in touch with us, there'll be contact details in the show notes below. But that's our presentation for today. So everything you wanted, and maybe a little more than you wanted to know about the ERC essentials for CFOs and controllers.
Well, great. Thank you so much, Catherine. And thanks for everyone who was attending. And as a reminder, we will email you in the next 5 to 7 days to let you know when the course for this presentation is ready on the Earmark app. So be sure to watch out for that email. We'll also email you a link to, like Catherine mentioned, for additional resources and anything that you need from this presentation if you want to learn more from her. Thank you guys so much. Talk to you next time.